Welcome back. You're tuned in to Editors Roundtable. Well, let's focus on the insurance space. And it appears that the bulls, well, they are back interested in the insurance companies, or at least they're looking to get insured, it seems so. Because in the last 1 month or so, if you look at it, well, the Nifty is up close to 4%, but these insurance companies that actually underperformed, they have come back into play. And in the past week, they're up anything between 10 to around 15%. What went so right? Well, let's put up a few factors out there. There was no adverse regulation that came in the budget. One of the fears was that maybe, in fact, the taxation that they pay, that could be moved up a little bit. That didn't happen. The second factor was, in the last budget, we saw that traditional products, where the premium was more than 5 lakhs, it came under the tax net. Well, the fear was that even those below 5 lakhs premium, that as well could get caught up. So that didn't happen as well. And the third factor was, currently, if your ULIP premium is less than 2.5 lakh, well, it doesn't attract tax. The fear was that as well could have been brought under the net. And all those three didn't take place, so the street was happy. The other factor was that the impact of the surrender value. People were fearing that this could have an impact. Back of an envelope calculation told you that it won't have more than 1.5% to 2%. But nonetheless, that was a bit of an overhang on some of these companies. But the managements have indicated that they are trying various ways to wriggle out of this. And few factors that they have been talking about is that the agent's commission, well, instead of it being paid all upfront, it could be delayed. It could be paid in a bit of a staggered manner. And also they're looking to squeeze in maybe a clawback clause. So that's what could help them as well and mitigate the fall of the surrender value out there. The industry basically is coming together, and it appears they're looking to bargain with the agent's commission. The third factor is, if you look at the results, they're fairly good. Whether you look at the APA or the VNB, they were fairly good in the past quarter itself, though margins, the VNB margins did come in for some pressure. But now the street is calling for bottoming out of the VNB margins. How is that? ULIP as a percentage of the total mix, that had gone up drastically. Now the indications are it's hit peak, and maybe in fact it'll pull back. Remember, ULIP margins are in fact relatively lower than the other products. So because of that, in fact, maybe bottoming out of VNB margins is something that the street is looking forward to. And finally, if you look at the valuations, if you look at the reverse, DCF, it implies that the street is now factoring in single-digit growth on the VNB. But maybe, in fact, it can grow in mid-teens or maybe high teens as well. If that's the case, then it has some valuation comfort. And even if you look at it on a price-to-EV basis, well, then, in fact, as well, it's not out of whack. It's more or less in line with the past averages. And some of them are, in fact, trading at a bit of a discount as well. So the short point is, insurers, life insurance, they came back. And the bulls, they got insured, at least in the recent past. But Rahul, since we've already spoken about insurance companies, I wanted your take on the defense space. You all had put out this elaborate note, with regard to defense companies, and they ran away. But now you'll have turned a little bit cautious on some of them. Tell us more.
So actually, Nigel, we initiated on this sector 4 months back.
Yeah.
And we took a very, very long time to initiate on it because the stocks had anyway gone up like 5 to 10x. We were wondering what to do with it. We took a risk. We came out with buy reports, and I think the upsides on most of the stocks were only 15-20%. But even after going up 5 to 10x, I think most of those stocks have more than doubled from the initiation. And for the kind of return ratios that they have, I don't think any defense company in India has more than a 20-25% return on equity or capital employed or return on invested capital. The order books are strong, but the working capital is entirely not in your control because at the end of the day, your biggest customer is the government of India. So you could land up making a product and it just lies there in the warehouse, and your earnings can be very cyclical and volatile. Now, superimpose that on the valuations, which were trading anywhere between 40 times for some to as high as, say, 90 times for, say, an odd Paras Defense in our coverage. We were just not able to make sense of it. I mean, it may not be the right way to look at 5-year, average multiples or even 10-year because the sector has sort of come into light only over the last 3 years. But even then, on a 3-year basis as well, 2 standard deviation above mean for those kind of return ratios, I'm not sure. Because, this is very similar to IT. Order books may not necessarily translate to revenue. It may look all right on paper that I have a 30, 40, 50,000 crore order book or even a 1 lakh crore order book. But that does not guarantee me. Let me just give you a parallel example. We were discussing NVIDIA a little while back. Dixon Technologies, since the time it listed till now, has moved in a 40 to 50 PE band. It has never fallen below 40, it's never gone above 50 because he's compounded his EPS by 30 to 50% every year since listing. That kind of certainty I don't think we had in defense. So given where return ratios are, growth expectations, it was just, and the point we made earlier, HDFC Mutual Fund, Defense Fund itself has not declared 45% of the amount that they've raised. So when one of the largest funds in the country is giving you that signal, I think it's something that you should take cognizance of. And I think, kudos to, Mazagon was what? It listed at what, 140, 150, I think? and it's what, at 5,500 now? Really? I mean, you know, what kind, if you want to buy a stock at 50 times, at our brokerage, we say you need to have at least a 15% upside. So what's my exit multiple? I mean, you want me to give it a Nestle type of multiple, which operates at 100% ROE, ROC with those kind of cash on books? We were not comfortable. We may be wrong, and I'm happy to go wrong, but sometimes you just need to apply a little bit of logic. I mean, if liquidity takes the stocks higher, so be it.
Okay, well, one final question, Rahul. This time there was a bit of a comeback in the IT names this week. TCS, Infosys hit fresh highs. The numbers were nothing great to write home about for the sector overall, but a lot of IT companies have told us that perhaps the worst is over, right? So whether it's Emphasis, a couple of others as well, saying that now discretionary spending is coming back, and you're also seeing BFSI, the BFS and BFSI segment doing well. Would you buy into any of these names?
So I must confess, we've had a change in analyst, and obviously when different people come in, their views also change. But I think what's helped is the banking results, since you brought up BFSI, have been good in the US. There has been no concern there. The US GDP growth came in just shy of 3%, so the US is on a good footing. And Europe's also not gone into any kind of mess that people were expecting. So I think we're fairly comfortable to see mid to high single-digit growth. I think valuations were trading in line with 3- and 5-year averages, which is why you saw the movement on TCS and Infi. But I don't think, Sonia, you can take an aggregate call. You also have a Wipro and a Tech Mahindra that also happened to the market. You also had a Zensar that happened to the market. Exactly. So I don't think it's
a structural, been a bit of a mixed bag.
But I think if you are to be in IT, I think probably Infosys and TCS would probably be, and maybe as a third pick, I would say an HCL Technologies. I think that's probably where it is. I don't think valuations are out of whack there.
Okay, well, on that note, thanks a lot, Rahul, for joining us. We have to wind up with this edition of Editors Roundtable. Thanks a lot for watching, but keep it with CNBC TV 18 for all the news and action.